1991, a year that changed India's economic trajectory forever, a time of crisis but also an opportunity for transformation. This is the story of how India opened its doors to the world and reshaped its future. Before 1991, India followed a path of self-reliance, influenced by the Soviet model, with a focus on public sector industries, a government-controlled economy with heavy state intervention. The economy was built around the license Raj system, where businesses needed multiple permits to operate. While this was meant to ensure self-sufficiency, it also created inefficiency, corruption, and stagnation. However, it is a misconception that India was ever truly socialist. The Nehruvian policies were focused on rebuilding industries that had been drained out by the British. By the 1980s, these industries had the potential for profit, leading business houses to lobby for privatization. The Bombay Plan, authored by industrialists, showed that the economic policies were never purely socialist. The government selectively nationalized loss-making industries rather than profit-making ones, contradicting true socialist principles. By 1991, India faced a severe economic crisis. Foreign exchange reserves had fallen to just 2 weeks' worth of imports. Inflation was skyrocketing, and the country was on the verge of defaulting on its international loans. Collapse of Soviet Union. This crisis was further exacerbated by the collapse of the Soviet Union, which had been a major trading partner, supplier of cheap oil, and a source of economic stability for India. Since the 1960s, the USSR was India's main importer, as India had strained relations with the West. However, by 1991, the USSR had collapsed, splitting into 15 nations. This led to the dissolution of the Rupee-Ruble trade agreement, which had allowed India to trade in rupees instead of dollars. The termination of these agreements in 1990 to 91 resulted in a steep decline in Indian exports to Eastern Europe, drastically reducing foreign exchange earnings. In this desperate situation, India had no choice but to seek assistance from the International Monetary Fund, IMF. The Gulf War and oil crisis. In 1991, the U.S. war with Iraq after Saddam Hussein's invasion of Kuwait led to a major oil supply disruption. With oil fields burning and ships unable to transport fuel, India, one of the primary buyers of Iraqi and Kuwaiti oil, suffered from severe price inflation, increasing import costs dramatically. Political instability in India. The 1970s and 1980s were turbulent decades in Indian politics. Emergency, 1975 to 77, saw democracy suspended. The Bofor scandal damaged public trust in leadership. The Indian Peacekeeping Force, IPKF, misadventure in Sri Lanka drained resources. 2 prime ministers, Indira Gandhi, 1984, and Rajiv Gandhi, 1991, were assassinated. Short-lived governments, VP Singh and Chandrasekhar, created policy paralysis. This instability led to a loss of investor confidence, triggering capital flight. Trade deficit and foreign exchange reserves crisis. India's exports were already weak due to a global recession and reduced demand from the Middle East. The Soviet breakup further slashed exports, and by 1991, India's trade deficit had ballooned. In 1989, India's exports were worth $17 billion, while imports were $21.7 billion, creating a $4.67 billion trade deficit. By 1990, imports soared to $23.8 billion, pushing the deficit to $5.86 billion. Foreign exchange reserves fell to a mere $1.2 billion, enough to cover just 2 weeks of imports. With non-resident Indians, NRIs, withdrawing deposits and commercial banks failing to renew credit lines, capital outflow surged. The Indian rupee depreciated from 12.96 per USD in 1987 to 88 to 24.47 cents by 1991-92. Further eroding investor confidence. Enter Dr. Manmohan Singh, India's finance minister, and Prime Minister P.V. Narasimha Rao. In exchange for a bailout, India had to reform its economy. Thus began the Liberalisation, Privatisation, and Globalisation (LPG) reforms. Key changes included simplifying trade laws. High customs duties and excise taxes made legal imports too expensive, leading to rampant smuggling. By lowering duties, Dr. Manmohan Singh effectively dismantled the smuggling networks, making legal trade more viable. Abolishing import licensing. Previously, Indian factories had to pay exorbitant licensing fees to import raw materials, increasing production costs and inflation. By eliminating these fees, material costs decreased, boosting industrial growth and lowering inflation. Structural adjustments. India agreed to economic restructuring under IMF guidelines, including devaluation of the rupee, reduction of fiscal deficit, and privatization of state-owned enterprises. The government pledged its gold reserves to raise foreign exchange, therefore abolishing the license Raj, opening up industries to private and foreign investment, reducing tariffs and import restrictions, allowing more market-driven policies. Singh emphasized that over-centralization and excessive bureaucratization had proven counterproductive. He advocated reducing government control, welcoming foreign investment, and exposing Indian industries to foreign competition. The hidden geopolitical angle. Some analysts believe India's economic turmoil was not entirely accidental. Key observations include: the West needed new markets as they faced stagnation. The U.S. Federal Reserve kept interest rates high in the late 1980s, 9.85% in 1989, attracting NRI funds away from India. After India accepted liberalization, oil prices and U.S. interest rates dropped, easing India's crisis. Western economies benefited from India opening its markets. The results were remarkable. India's GDP grew at an unprecedented rate. The IT sector flourished, foreign investments poured in, and millions were lifted out of poverty. New businesses thrived, and India's middle class expanded. The compounding effect of liberalization has added trillions to India's GDP over decades. Since 1991, India's foreign exchange reserves have increased 127 times, making India the fourth largest holder of reserves, behind only China, Japan, and Russia. However, liberalization also brought challenges: income inequality, job displacement, and increased dependence on global markets. Despite the reforms, India remains a heavily interventionist economy with strict regulations such as floor space index (FSI) restrictions, which limit urban expansion. Negative impacts. Rising income inequality. Economic growth benefited urban areas more than rural regions. Wealth gap between the rich and poor widened significantly. Decline of some traditional industries. Small-scale industries struggled to compete with foreign products and large corporations. Many local businesses shut down due to increased competition. Jobless growth. While the economy grew, formal employment did not increase at the same pace. Many jobs were in the informal sector, with low wages and no job security. Environmental issues. Rapid industrialization led to pollution, deforestation, and resource depletion. Urbanization resulted in issues like traffic congestion, waste management problems, and water shortages, vulnerability to global crises. India's integration into the global economy made it more sensitive to global financial shocks, e.g., 2008 recession. Over-reliance on foreign investment and imports increased external risks. Today, India is the fifth largest economy in the world and is expected to become the third largest soon. Startups, digitization, and manufacturing are driving growth. However, debates continue. Should India further liberalize, or should the government play a larger role in managing the economy? While dismantling tariff walls could strengthen India's manufacturing sector in the long run, protectionist policies remain popular among some groups. The 1991 reforms were a turning point, but the journey of economic evolution never ends. As India looks ahead, the balance between free markets and government intervention remains crucial. After China liberalized its economy, hundreds of millions escaped poverty. Similarly, when India embraced economic freedom in the 1990s, poverty saw a remarkable decline. What do you think? Should India continue on this path or take a different approach? Let us know in the comments below.